Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we've got Cohen and Steers Inc. getting ready to do some serious borrowing. You could say they're flexing their credit muscles, and we're here to see what it all means for their future operations. Before we dive in, if you love getting the inside scoop on what companies are really up to, make sure you hit that subscribe button and turn on notifications. Also, we've built an awesome community over on Discord where we break down all sorts of financial news and documents, so definitely join us there. The link is in the description below. Alright, so Cohen and Steers has just dropped a Form 8K. Think of this as a special report card filed when something big happens between their regular financial updates. The main story here is about their credit line, which is basically a big loan they can tap into whenever they need cash. They've made an amendment to their credit agreement. That's like signing a new contract that changes the terms of an old one. This isn't a brand new loan, but an update to an existing one from January 2023. So what's changed? The big news is that this agreement, which will now be called the amended credit agreement, is for a $100 million senior unsecured revolving credit facility. Let's break that down. Revolving means they can borrow, pay it back, and borrow again up to that $100 million limit. Senior unsecured means it's a high priority loan for lenders, and it's not backed by specific assets of the company like a building or equipment. This big credit line now matures in August of 2029. That means they have until then to pay back whatever they borrow under this facility. It's a pretty long runway, which is generally a good thing. They've got Bank of America as the main bank handling this, acting as the administrative agent and the lead arranger for this loan. So what will they use this money for? The filing says it's for working capital and other general corporate purposes. Working capital is essentially the money a company needs to run its day-to-day operations, like paying employees, suppliers, and covering immediate expenses. General corporate purposes is a broad term that can cover almost anything the company needs cash for, like investments, acquisitions, or even returning money to shareholders. Like investments, acquisitions, or even returning money to shareholders. Like paying employees, suppliers, and covering immediate expenses. General corporate purposes is a broad term that can cover almost anything the company needs cash for, like investments, acquisitions, or even returning money to shareholders. Now, let's talk about the cost of borrowing. The interest rate on this loan is variable, meaning it can change. They have two main options for how the interest is calculated. One is based on term SOFR, which is a benchmark interest rate, plus an applicable rate. The applicable rate is determined by a performance pricing grid. What this basically means is the rate they pay goes up or down based on how well the company is performing. If their financials look good, they might get a lower rate. If they struggle, the rate could climb. The other option is based on a base rate, which is another benchmark, again, plus that performance pricing grid. So in simple terms, their borrowing costs are tied to market rates and their own financial health. Besides the interest they pay on money that actually borrowed, they also have to pay a commitment fee. This is a fee for simply having the credit line available even if they don't use it. This fee is also tied to their performance and is paid quarterly on the unused portion of the loan. It's like paying a small fee to keep a credit card open and available. The good news is that Cohen and Steers has flexibility. They can reduce or cancel their commitment to borrow or pay back any amount they've borrowed at any time. They just need to give the banks proper notice and potentially pay any fees associated with early repayment. This flexibility is crucial for managing their cash flow efficiently. Now, all these loans come with strings attached. The agreement includes financial covenants. These are specific financial targets the company must meet to stay in compliance with the loan. The filing mentions leverage and interest coverage ratios. Leverage is basically how much debt a company has compared to its assets or earnings. Interest coverage is a measure of how easily a company can pay the interest on its outstanding debt. If they fail to meet these targets, it could trigger a default, which could mean the entire loan becomes due immediately. There are also affirmative covenants, which are things they must do, and negative covenants, which are things they cannot do. These often include restrictions on taking on more debt, selling off important assets, or making major changes to the company. However, the report does mention that many of these restrictions have usual exceptions and thresholds, meaning they aren't absolute and can be worked around under certain conditions. This is pretty standard for these types of agreements. Finally, the finding lists the exhibits. The most important one here is the actual text of the First Amendment to the credit agreement itself. This is where you'd go to find all the nitty-gritty details, but for our purposes, the summary tells us the core story. So to sum up, Cohen and Steers has secured a $100 million revolving credit line that matures in 2029. This gives them breathing room and flexibility for their operations and financial management. The terms are tied to market rates and their own performance, which is a double-edged sword. Good performance means lower costs, but shaky performance means higher costs. Now, what's my take on all this? Cohen and Steers is an asset management firm. They manage money for clients, and their success is often tied to market performance and investor confidence. Having access to a substantial credit line like this $100 million facility signals a few things. First, it shows they have relationships with major banks, which is a positive sign of credibility in the financial world. Second, it provides them with the liquidity they need to navigate potential market downturns or to seize opportunities like making strategic acquisitions or investing in new technologies. The fact that they have a performance-based pricing grid is also something to watch. If Cohen and Steers is performing well, managing assets effectively and growing their business, they'll likely benefit from lower borrowing costs. This could free up more capital for their core business operations or for rewarding shareholders. However, if their performance falters, those borrowing costs will increase, putting more pressure on their profitability. A key risk here is the general health of the financial markets and investor sentiment. Asset management firms are directly impacted by how much money investors are willing to put into markets and their confidence in institutions like Cohen and Steers. If there's a major market downturn or a loss of investor trust, it could impact Cohen and Steers' revenue and their ability to meet those financial covenants we talked about. Diversification of their services beyond just traditional asset management might be a strategy to mitigate this risk, though we don't see details on that in this specific filing. Overall, this amendment to the credit agreement appears to be a strategic move to ensure financial flexibility. It's a standard practice for companies of Cohen and Steers' size and nature. The real story will be how they utilize this credit line and how their underlying business performance holds up against market conditions. A strong performance will make this a very positive development, providing ample dry powder for growth and stability. So that's our breakdown of Cohen and Steers' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.